both of your texts at like times when I was doing something else and I forgot, and then I remembered this morning and still didn't text you back.
Yeah, well, you officially just said that on YouTube, so everybody knows how bad of a friend you are. Here we go. Where are we? Yep. All right. So we're live on YouTube. I don't even know what these texts are about. I sent you so many texts. It's not non consequential to me.
You don't even care about the text you send me.
I barely even think about it, honestly. I'm just barraging you with information. All right, we ready, bud?
Yeah.
Okay. Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Today is July 1st, and that means what? 6 months of the year have officially passed. And what tends to happen in these circles is people start giving out their predictions around what the second half of 2025 and what's going into 2026 is going to start happening. We found a couple of articles, a couple of sources, and we're going to recap what people are saying, and then we're going to give you a little data with perspective. I am your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC, because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you.
It is fantastic to be with you too, Greg. I am in the mountain office of the Not Your Average Investor Show. I feel like I've done probably about like 8 or 9 shows from here before. It's here in my family's house in North Carolina, buddy. How's the weather in Jacksonville? Because over here, I've been working from the back deck. It's like 70 degrees and sunny. It's gorgeous.
Oh man, you're just rubbing it in, huh? It's pretty hot. It's pretty hot down here. Not gonna lie.
Yeah.
You know what? It has been a lot hotter. I was taking a walk with my dog last
Yeah.
night, walking around. My mom was in town as well, and we were both walking the dog, and we were both like, you know what? It's all about being the beauty of low expectations and expecting very high temperatures. So it's better than expected.
Yeah, yeah. It it has been hotter than the past couple of years, feels like in Jacksonville, for sure.
Yeah.
For sure. All right. Well, you know what's really hot on the streets right now is what we normally start our show with. You know what that's called?
The roll call,
No roll
baby.
call, baby. We got King of the Beach checking in first, Christopher Lee, Fernandina Beach. We got the early bird checking in second, Dean Curry. We got Le Monsieur Reggie Francais from Landland Empire. Welcome. Bonjour, Reggie. We've got Il Maestro, world famous composer John Williams from Long Island, New York. We got the ringmaster in the house, Drew Barnhill. We got our leadoff hitter batting, I think, 6th or 7th today, John Henning. We got our regulars, Gary and Rosalind Riley from Marietta, California. We regard you. We got Leo Faraganan. Faraganan. We don't get to see Leo that often anymore, man.
I
Dude's
know,
busy
always
at
a
this
great
hour.
day.
Love to see you, Leo. Love to have you here, buddy. We got Lewis Hudnall, the not happy about the trade with the Dolphins in Rockland, California. Did I send you that text, Greg? I was like, man, you guys got Aaron Rodgers and Jalen Ramsey in one offseason. Really going for locker room guys, huh?
It's not your father's Steelers over here. It certainly makes for an exciting offseason. I mean, normally the offseason for the Steelers is so boring. You know we're not going to do anything in the draft. You know we're not
Mhm,
going to do
mhm.
anything, any big free agents. This
Yeah.
is different, so maybe we have a different result.
Lewis, when Lewis shows up, the Steeler commentary follows. We've got the Queen of Logistics, Michelle John from Jacksonville, Florida. Is the Queen of what is it? What is something of logistics?
I'm
Anyways,
gonna go with the Queen of
the
Logistics. That
queen, the
sounds
queen of the
fantastic.
queen of logistics. Good to have you. We got the mountain man, Billy Green from the mountains of Colorado. We got LinkedIn Lowry in the house from Jack's Beach. Ed Lowry. Who else we got in here? Oh, we got Big Papa's in the house. I love it when he calls him Big Papa. Co-founder of the co-founder, Jay Cohen. John Evans checking in with a good afternoon. Saren Jennings from New Jersey. No, Pablo, I am not new to the group. You're right, Saren. I
That is
just
so good, sir.
preemptive strike. Thank you, Saren, because I probably would have messed that up. We got the first family in the house, the patriarch and matriarch, Ken and Carolyn Moline. We salute you.
You.
Who else we got in here? We got Chris Lee. We got Laura Colby from beautiful Washington State. Is Billy Green wants to know, is Tammy Miller in the house? I got a text from Billy Green saying that he's got his friend named Tammy supposed to be checking into the show. Tammy, we want to hear from you. We got Linda Mercurio from South Carolina. Linda Evans from the Villages checking in. Good to have you. Where else? Man, this is a good roll call today. Good roll call
Pops.
today. Daniel Riley, your boy.
Oh, that's awesome. I love Dan. I'm so glad to have him here. And I also wanted to say a special thank you to Lori Colby. Laura, I was so impressed. I got to meet Laura and her family.
Yeah.
Um, it was about a month ago now. She came down to our office and we had a great conversation. And you know what? You have good friends. We just have this amazing community. She sent me a book. And we were talking about how passionate we are about raising our kids in a way that they understand how to invest and how to improve their lives, but other people's lives around them. It was this great conversation. She sent me a book, The 7 Habits of Highly Effective Families. And so, Laura, I just got the book. I just got to the office. It made its way to me. And I wanted to say thank you for sending that. It was incredible. I can't wait to read it.
You told me all about that on our morning walk this weekend, buddy. I know
I
well.
did.
Who else we got in here? Ernest Gadagas saying that we start. Ernest, this is how we always start, with a roll call, my friend. Welcome to the show. Amir Yunan from LA. A couple of new names. Good to have you all here. Hope you make a habit of coming and hanging out with us. We got one more. Pankaj Patel from the Sunny Bay area. Good to have you, Pankaj. Right along, Raj is in the house. Good to have you, Raj. And of course, the patron Santorios of the Not Your Average Investor community, Michael Santorios in the house, checking in. James Gamble from Racine, Wisconsin. Good to have you. This is a lively roll call today. What do you think?
There we go. I love it.
I think people like prediction shows. You think that's what it is?
I think they just like you. I think they're here to see you.
I mean, yeah, but that doesn't change week to week. All right, GC. That being said, we have halfway through the year. As this always tends to happen, right? We start to get the talking heads. They know they like prediction shows. People like prediction articles. So of course, headlines start to appear everywhere of the trends that are coming out. We did a little bit of research here. We found a pretty decent article that kind of like summarizes a whole bunch of different predictions across the housing market, mortgage rates. It's got a couple of different takes here, what sales are going to do, and the demand puzzle, all these types of things we're going to talk about. So we're going to hit one by one, just kind of like talk about what the talking heads are saying here. And then we're going to give the data perspective. We're going to give Greg's answer to what he thinks is going on with his own sources. But if you haven't yet, the one source that we recommend you go get is our Q2, Q3 JWB real estate market update. This is the show that we do every quarter that gives Greg's latest thinking on it. We have now turned it into a publication, so you can now get this. Greg, you wanna show it off what it looks like in person there?
Oh yeah. I just happen to have one right next to me. What do you know? But this is something that Pablo and myself, our entire team, really spent a lot of time taking all the thoughts and the ideas that we brought to that quarterly market update show and give it to you so that you can read through it at your leisure. And it will certainly help you make better decisions when it comes to your money and your money specifically in rental property investing. So I hope you all get it. It's a free gift for everybody that would like to go ahead and request it. You just have to go to jwbrealestatecapital.com/report.
There you go. jwbrealestatecapital.com/report. Joanna put it into the chat, so you can just click on it and pick it up. So that being said, let's get into some of these predictions. GC, let's start with home price growth. What do you think? Does that sound like a good place to start?
There you go. That's what all the headlines start with.
That's where they like to go. All right. Basically, the summary is saying Fannie Mae's Q2 2025 Home Price Expectations Survey, which is a panel of 100 plus experts, they project home price growth will slow to 2.8% in 2026, down from 5.3% in 2024 and 2.9% in 2025. This reflects a continued cooling of the market and a shift toward more sustainable appreciation rates. The National Association of Realtors forecasts that the median home price will rise by 4% in 2026. Their projection puts the median price at $420,000, about a 2% increase from 2025, reflecting a consensus of modest gains. So that's and then Zillow economists predict a possible 1.7% decline in home prices from March 2025 to March 2026, suggesting some regional variation and potential for price corrections in overhead markets. Do you see? Those are three very different kind of like takes there. What do you think?
Well, it's funny when you mentioned like 100, experts on this panel. I'd love to know who those 100 experts are because I see these articles all the time and, pretty much every quarter or I don't know, maybe even sooner than that, they tend to come out because they get eyeballs and all that good stuff. These predictions change wildly and nobody can remember what anybody predicted in the past. And, it gets the eyeballs and the attention, but it really doesn't have, I'd love to measure their predictions versus absolutely what happened because, as we've been seeing for years and years and years now, people have been predicting housing crashes. They weren't right about that. So I guess my first reaction is these articles, they are there to attract headlines, but they don't really help us understand what's going on in our market. And most people who think that they're real estate experts really don't have a great track record of predicting what's actually going to happen. The one thing I'll also add is specifically on the nature of this of the headline is all about the U.S. housing market. And there really is no U.S. housing market. When you talk about U.S. housing market, it's interesting to understand what housing prices have done or some of the other things that we'll measure, but it really does not help us make any decisions on as what's going on in your local market. So my first response when I see a headline like this is I don't really pay attention to whatever they say, to be quite honest, because it doesn't help me make better decisions where I'm putting my money. But if I'm putting all of that to the side and I'm saying, could they be right? Sure, all three of them could be right. Really, the most important thing when we think about what housing prices are going to do across our country, the most important determining factor is what are interest rates going to do. So if anybody knows what interest rates are going to do, then I actually think that we can have a prediction as far as what housing prices are going to do.
Got it. So interest rates really are kind of like the biggest lever that if anything moves, it's de facto going to change housing prices. That being said, I mean, are you just sitting in the sidelines saying we don't know what interest rates are going to do, or are you out there kind of like trying to think of what's happening? Where do you get good advice on like where things are going that you do pay attention to, GC?
Well, I mean, I pay a lot more attention to what's going on locally. I
Mm.
think that's what really matters. If you're an investor and you have your money in a market, either you or the team that is managing your money in that market should really know exactly what's going on as far as pricing, as far as months of supply, making sure we understand where inventory is. So if we start to talk a little bit more about what's actually helpful here, it's more of the individual market. We could talk a little bit about Jacksonville. Tend to we did that right on this Jacksonville real estate market report, and on the market update, but we can kind of hit some of those things. I think that's what's most actionable here. And what we're finding is, specifically in Jacksonville, what we're experiencing is what we've kind of coined this coil effect, right? Higher for longer interest rates are suppressing housing demand that otherwise would be there, but it doesn't eliminate it. And so our home prices in Jacksonville have actually gone down about 1.5% this year, which is unusual. It doesn't usually happen that way, especially in the summer months. But all that's happening is it's just the coil effect. It is suppressing or pushing off demand that otherwise would have been here for home sales. And those people still want to buy homes. So as soon as interest rates do get some relief, you're going to see mortgage applications go up. You're going to see more home sales. And then you'll see increased home price appreciation and making up for the years where home price appreciation has been lean, mainly due to the higher for longer interest rates.
The coil effect. I feel like I should go back and explain that a little bit. We can actually use some of the data from the quarterly market update when we talked about this idea that last time that interest rates dropped this much for this long, we have a really good comparison, right? In 80 to 82, interest rates in 2 years dropped the same amount. Increased for the same amount that they've increased now. The percentage in actual sales volume decreased the exact amount, right? So same amount of time, same amount of interest rate hike, same amount of decrease in sales, right? Not in pricing. So very, very one-to-one what happened in January 80 to August 82 to what's happened in the last couple of years here in this economy. And then when you look on the other side of it, once interest rates started to come back down, there was much higher than normal home price appreciation, 4% gains the following year and 4.8% gains the year after that. So what we call the coil effect is the idea that when interest rates stay high, it is not that it's taking away demand, it's that it's delaying it. And what it's doing is kind of like a winding coil that the longer it winds for, the more compressed it gets. When the pressure relief happens in the coil, bang, springs, then you get this like increased demand, this increased home price appreciation, and a bevy of sound noises that I like to make with my mouth.
Well said, and well sounded out. I think you did that quite well.
Thanks,
So
man. Thanks. So the coil effect, right? So that's what we see happening. It's not just supported by when you talk about a local market that you know very, very well, the coil isn't just a interest rates are suppressing stuff. We're also looking at indicators like average wage growth that's really happened a lot in Jacksonville, net people moving here, that's really happening a lot. You want to talk a little bit about those indicators?
yeah, absolutely. I mean, there are, let's just say that interest rates stay the same forever that they are right now. You want to look at other things that are going to drive housing demand, which ultimately drives home price appreciation, rent price appreciation. And we need median incomes to go up to support all of that so that our homes are affordable. And so if you're thinking about where to put your money, it's just really simple. Just look at the places where population is growing. That's the easiest thing you can look at. When you're looking at population growth, you're also seeing that median incomes are rising. You're also seeing jobs are going up. You want to make sure it's a strong economic base before the jobs are rising. But yes, you're seeing jobs going up. And you want to make sure you're in a market where you have at least 1 million people living. So these are just some basic things. If you're thinking about where to put your money, you're going to win in the long run in rental property investing. Look to put your money in those places where people want to be, where people want to move, because all of these things, independent of interest rates will be whatever they are. The way to win in the long run are those markets where population's growing, median income's going up, the job base is strong and it's growing as well.
Totally, man. So when you do look at this home price data, people that give predictions, I think the you have a kind of like a go-to source, right?
Yeah, absolutely. So, and it's nice to, there's even in as you guys were preparing the research for the show, there's whatever 4 or 6 different sources. They all sound very respectable and credible. But it's nice to have one trusted source where you can compare apples to apples, and you have a way to go back and look over time and say, hey, when you predicted something, how accurate were you? Were you generally a little bit more positive, or are you more conservative? And one of the benefits that we have is we spend a bunch of money with a consulting firm named John Burns Real Estate Consulting. We love them. They're fantastic. And it's the basis of a lot of the thoughts that we have here at JWB as far as our Jacksonville market in relation to, the rest of the U.S. housing market. So I went and I pulled some of the data that John Burns has had. Because I am not a U.S. housing market expert. None of them really exist. All you can do is just kind of compile all of the experts and all the data from the individual MSAs. Long story short, here's what John Burns predicts as far as home price appreciation in 2025 and also an eye through 2028. If we're looking on the left-hand side, Pablo, you have to help me with colors. What colors those?
John Burns is in like navy blue, and Fannie Mae is in some variation of green that I don't really know how to describe. It's like a bluish green.
There we
It's
go.
perfect. It's perfect for people that have problems with color blindness.
There we go. There we go. So Burns is predicting 1.7% home price appreciation across the United States. Fannie Mae is predicting 3.4%. And you can see in future years, Burns is predicting more and more. Fannie Mae is predicting more most of those years. And then you can also compare what has Burns predicted versus what has Fannie Mae predicted. And I believe that's through 2020. Oh, okay. So they're predicting it through 2028. So it's a little bit forward looking. But there was another bit of data I didn't put on this slide, but it actually compared how close Burns was to Fannie Mae's predictions over the years, and they're more conservative than Fannie Mae if you go back since over the last 15 years or so.
Got it. Got it. So Burns seems to be, I guess, if we're looking at the different predictions from Fannie Mae and the NAR and Zillow, Burns seems to think, Zillow is saying there's going to be a decrease. NAR thinks it's about a 2% increase, and Fannie Mae thinks it's about a but like 2.8% increase. So Burns seems to be a little bit more conservative than more conservative than Fannie Mae, slightly more conservative than NAR. Definitely not the same as Zillow that's predicting the decrease, man. What are you thinking as far as Jacksonville? I know that in the quarterly market update we said that prices had slightly decreased year over year, right?
Well, they have now, and what I'm referencing is the home pricing through the beginning of this year.
Yeah.
So generally, when we're talking about home prices, we give an entire year to say, oh, have home prices increased or decreased? Now, what we're doing is we're looking at year over year data for the first 6 months. So it's a little bit incomplete. But for Jacksonville, what I'm looking at is, you know what? Typically, spring and summer are your highest the highest appreciation quarters, months of the year. And so you generally are setting new home price gains, and generally it's the highest home prices you've ever seen, and that usually comes in, May, June, July timeframe. So for us to be in the spring and summer season, and for us to be 1.5% roughly below as far as the decline, that's unusual. Now that may continue, it may not. A lot of it is dependent on interest rates. Obviously, at the end of the day, it really doesn't matter as we talk about what the coil effect is for buy and hold investors. But if I'm not going to guess as far as what interest rates are going to do because we just don't know. There's too many factors. But if, knowing that we're through spring and now in summer and we're not setting new pricing highs, I'm going to assume that that's probably likely to continue for the rest of this year. And really, until we start to see lower interest rates, that's when the coil effect is going to rebound and bring that higher home price appreciation back.
Awesome, man. So we're kind of seeing going forward better news and than looking in the rears. Ernest Gargas is saying he's talking about how pricing in San Jose has gone up and stayed about the same, and there's these salaries, right? They basically said in San Jose you need to make 160 grand a year to like support the cost of living. And it sounds like you're saying that's a downward pressure in that economy. The good news in Jacksonville is, why don't you share the good news in Jacksonville as far as like salaries and cost of living and stuff like that, GC?
Yeah, we shared this on our quarterly market update, and it's in the report if you'd like to see it as well. But our median household income in Jacksonville has gained about 25% over the last roughly 5 years. We were at about $66,000 as far as our median household income just roughly 5 years ago. And now I believe it's about $83,000 or $84,000 is our median household income in Jacksonville. That's one of the fastest growing median household incomes in the country. And that is, at the end of the day, there's such value for people moving here. And you lump in, quality of life, like no state income tax, right? The ability to be outdoors, the job base here. We have 4 Fortune 500 companies, and we were the #1 major city for corporate net relocations just a couple of years ago. So you have all of these things that are just driving value for people wanting to move here. And when more and more people want to move here, good things happen. Median home incomes rise because we become a talent destination for employers. And we're seeing that over and over again. So there are so many positive trends. I would recommend for people to really keep an eye on median household income if you're considering investing in a market. And don't just get excited about what's on the horizon, because I think most people can paint a rosy picture for what's happening in the future, what's going to happen. But if you can look over the last, call it 5 years, and see significant median incomes in, growth, ask yourself, why is that happening? There's a ton of value for somebody to move to that market. And then you're in a place where you can invest in something that you don't have to hope improves. Now, if you get something where things are improving like we are here in Jacksonville, median home incomes and other things, and then you also have an eye for the future of what can really take it to the next level, that's where it gets really exciting. That's where we get into some of the downtown Jacksonville revitalization conversation. But, sometimes when I talk a little bit about that, people say, oh, well, it's just rosy pie in the sky. It's not here yet. And so many times I say, well, let's not even count on that. I believe that's going to happen. Let's not even count on that. Let's just look at what's happened for median incomes, population growth, job gains. More Fortune 500 companies have come here in the last 5 years. look at those things and what story is it telling you? And do you want to put your money kind of riding that wave?
Yeah, yeah. And Ernest got a great question here saying, what type of jobs are there in that area? Ernest, we've got this really, really well balanced economy here in Jacksonville where the main sectors are pretty inelastic, right? Like we've got logistics that is always humming, is a big one. Finance and fintech. We've got healthcare and healthcare tech. And then we have a really, really big military sector, right? We're kind of like the third big naval city after San Diego and Virginia in that area. So it's just like a really, really well balanced economy that it's being really bolstered right now by this. There's a new big economic engine coming, which is University of Florida starting this graduate campus for fintech and healthcare tech that's powered by one of the biggest, like the biggest um, AI computer, supercomputer that's held inside of a public institution. So just really forward facing opportunities there, as well as this like really well balanced like blue collar class and economic drivers that always seem to be going along because it's just kind of like the infrastructure of what we need, right? Like money, logistics, healthcare. everybody always tends to need that, unlike other places in Florida that are greatly hospitality and construction that have their like wild swings. We really don't have a lot of that as the foundation. So pretty good stuff. I see a Go Gators in the chat. I have to assume that's Sergio Preto.
Oh, it's got to be. Go Gators,
I
buddy.
mean, it's got to be Sergio. Good to have you, Sergio. All right, GC. So that being said, let's move on to the next set of predictions, which is mortgage rates. We've got. Let me see. Let me just get this article right, so I'm not highlighting the wrong thing. Yeah, we got pretty similar predictions here. NAR is saying mortgage rates are going to stay around 6%. Fannie Mae thinks they'll be around 6% by the end of 2026. JP Mortgage is saying that it'll only drop to like 6.7%. What do you think, GC? What do you think about kind of like chances of mortgage rates really coming down or kind of staying the same, or where do you think they're going to go?
I just think everybody who's predicted them is made to look like a fool over the last couple of years. And
Yeah.
so I just don't see a lot of value in predicting them. That it is so volatile. Interest rates are a function of a number of things, but the biggest things that drive interest rates are inflation data, our labor market, and fear of as far as where people are putting their money. When there are world events that are causing fear, people tend to put their money into bonds. And when the yield of a bond goes down because so many people are putting their money in it, it in effect drops our long-term interest rates. There's so much that goes into it. And if anybody can
Can I break
say
that
with
down real quick, GC? Because I don't think you've ever explained that to me this way, right? So
yeah,
like if fear makes people go to like the safest investment, which is municipal bonds, right? Is that what you're saying?
no, not municipal bonds. This would be
Uh-huh.
like 10-year treasuries.
10-year
So,
treasury bonds. Okay.
yep.
So making people go to 10-year treasury bonds, that means that the supply of bonds versus the demand kind of like starts to change a little bit, which then drives down the long-term interest rate in order to keep that competitive. Um, I see a world that's full of fear, right? Like we are on the brink of World War III. We are running very adverse internal political campaigns that is causing domestic, violence in inside our country in ways that we haven't seen in a really, really long time. Wouldn't that wouldn't that build the case for the idea that interest rates are likely gonna be coming down?
If only it was that simple. It's not that simple. But yes, your basic premise is right. When people are fearful, they tend to take their money out of equities and they put it into bonds. They tend to take their money out of something that has more of an upside, and they tend to put it in something that has a high floor, because people are scared. That's the way that we work as human beings, right? And so people tend to take their money from the stock market and then put it into bonds. And when that happens, the price of the bond goes up and the yield of the bond goes down. And the reason that's important for us as investors to understand is that a bond is a similar type of investment to a 30-year mortgage or a mortgage-backed security. And so a 10-year treasury is the closest kind of comparable investment to what somebody who would be investing for a mortgage-backed security would be. And the reason for that is because most homeowners own their home, have their mortgage before they either sell or refinance somewhere between 7 to 10 years. So So just think for a second. At the end of the day, we want people to think it's a good idea to lend their money on our houses that we're going to have debt on it for 30 years if we want it. We want them to look at that and say, hey, it's a really good idea for us to put our money in that, invest in that at a much lower interest rate. That's what's on the other side of what we think about as our interest rates that we pay on our mortgages. So it's got to make a lot of sense for that investor on the other side to say, hey, you know what? I'm going to take that deal. It's a good investment if the interest rate is only 6% or lower. The way that they make that decision is they look at their alternatives, and they could either put it into a bond or they could put it into a mortgage-backed security. And they look at those as roughly pretty similar. So when the yield of a bond goes down, also the yield or the required interest rate on our mortgages goes down. And so if we're all rooting for if we're rooting for low mortgage rates, we want more demand for bonds, which drops the yield for bonds, which makes it more attractive to have a lower yield requirement on mortgage-backed securities or a lower interest rate requirement on mortgage-backed securities, which makes us happy that we get a lower interest rate to pay. Does that all make sense?
Yeah.
Okay.
Yeah. That all makes sense. So I guess it just seems like a very complicated equation, which
It's so complicated.
It's kind of why like everybody, it feels like this is the Burns data again, right? Like with more people predicting it, everybody's kind of like in this like 6.4 to 6.7 range. Feels like nobody really wants to take a stand on, or is there going to be a lot of movement in interest rates?
Well,
But I don't understand how to explain that when the world is so volatile and it does feel like we're moving towards fear.
let me take a stab at it. Okay. So it's not that that people are afraid to take a stand. It's that there are so many competing stands that people don't know which one is going to outweigh the other. So your point about this being a highly volatile world right now and a highly volatile economy right now, and geopolitical there's a lot of volatility. It's very, very true. To me, I feel like it is the most volatile I can remember. That would lead to more fear in the investing world and lead more people to go to bonds. Well, here's the other thing. Inflation really matters because when you invest in bonds, you are the lender, right? In high inflation markets, in the economy, when there's high inflation, as a lender, you don't want the value of your investment to erode, and that's what inflation does. So when people are thinking about moving huge sums of money into bonds and they see high inflation, it makes them not want to do that. Because if they do that, it erodes their purchasing power. It erodes their investment, right? If inflation is 4% and the bond is a yield of 3%, I'm just coming up with something, then ultimately they're not making money on that. They're losing 1%. Because inflation is eroding their purchasing power. So you've got the fears of inflation. Well, inflation's actually really low right now measured by the CPI. So we should all be happy about that. But now we have tariffs that could really change things, and nobody knows the effect of those. So now people are fearful of what inflation may bring in the future, and it's keeping people away from investing in bonds as much as they otherwise would have, even though people are scared about other things that are going on in the world as well. So you have a lot of competing, very strong desires for the investor and fears of the investor, which nobody really knows how it's going to land. We just need time to tell us.
Got it. So where's it going to land?
Well, I'll tell you exactly where it's going to land.
Yeah. Got it. So you're basically saying, it's hard to predict. It seems like it's going to be kind of like where we're at. I'll
just kind of tell you like what's in my head and what I think what should be in your head as an investor is, rather than spending a whole lot of time trying to predict what's going to happen in the future, assume what you know today to be true and find something that makes sense. Find an investment that makes sense.
Yeah.
And as we just talked about in the quarterly market update, we did a deep dive on why it makes sense to invest in single family rental properties more than most other asset classes. while interest rates are higher and while home sales are lower and while there's fear in the marketplace and fear in the world, why does it make sense? Don't count on things changing. And then, we do believe that interest rates will come down. We do believe that things will be better for the real estate market in the future. Then you're just under promising and over delivering for yourself. And so that's where I would move people towards. It's understand what to do in a high interest rate environment. Don't count on it to change, because everybody who's been counting on that to change and made investment decisions based on that is not happy, or they're looking, it's not the best thing they could have done for themselves. So don't try to time the market. Understand why it makes sense based on the information that you have today.
Love it, man. Good explanation. I'm glad. Thanks for answering all my questions. Right. Like I feel like I get to ask the questions that everybody wants to ask. So thanks for being in there. All right. So up next. Yeah, go ahead.
Well, so I do feel like I've kind of like skirted away from some of the actual things that I think, and I've probably devalued a lot of these articles and whatnot more than actually giving my take. I'll tell you, like, for me, when it comes to interest rates, I'm not assuming that they're going to come down as much as I was thinking a year ago or 6 months ago. I think I'm in the camp where 6 months ago I thought they were going to come down because 99% of America thought they were going to come down. Mm-hmm. Now I just see a lot of competing forces, and I don't know what's going to outweigh the other. And so, for our business plan going into next year, we'll do that in October. If nothing has changed between now and then, I'm going to assume we're going to plan on higher interest rates being here for a lot longer, because it's the more conservative approach. But what I also know is that when those interest rates come down, I expect there to be a large resurgence, especially in home sales. And then I think home price appreciation is to follow. So this works when you have a buy and hold mentality. When you are not making decisions today that have to pay off 1 year from now or 2 years from now, this mindset works. And that's why investing in single family rental properties makes so much sense today while interest rates are elevated, because you don't have to know the answers to these things for you to make a wise decision.
Makes sense to me, but I'm glad you took the bull by the horns there and made a declarative statement. I appreciate it, man.
There you go.
So up next is the home. Sorry, I had to kind of come off of this thing. You know what? I'm gonna take a hard veer here. We haven't really prepared for this, but Right Along Raj is asking, rents are slightly lower in South Florida as compared to last year. What are the rent forecasts in Jacksonville for the next few years? We hadn't really, we don't have any kind of like research on rents. It wasn't going to be part of the show, but since Raj is asking, what do you think, GC?
Yeah, well, I think we are in a very big position of strength, specifically in the Jacksonville market. I actually did look at the U.S. predictions as far as rent growth for Burns. I predicted about 2.5% rent growth for the overall U.S. for single family, and I think it was about 1.5 to 2% rent growth for multifamily. So he sees both of those going up across the United States. But if I'm just specifically looking at Jacksonville, I see a lot of potential for rent gains coming into 2026. And here's why. The things that were holding back additional rent growth over the last couple of years have subsided. So specifically, Jacksonville rents have gone up a little bit less than 1% from last year to this year. And that's less than normal. It usually goes up about 3.6% each year. So that's what we have called a soft rental market. Well, the thing that was driving the soft rental market had very little to do with actual single family housing. What was happening is multifamily apartments were being built at a level that we hadn't seen in decades. And that was driven because there were low interest rates a few years ago, and because Jacksonville is a place where people see population growth and median income growth and all those things that I'm sharing with you. And the big money guys and the big money girls said, listen, let's go and build apartments, because that's a great way for us to earn a return on investment. Well, that's happened over the past few years. We built a ton of them, and we became oversupplied for multifamily and apartments in Jacksonville. And in 2024 to 2025, that has been absorbed, and multifamily apartment starts are down 75% from just last year to this year. So all of those apartments are being absorbed we're seeing multifamily occupancy increase now for the first time in a while. And what that is doing is it's allowing single family to act like it normally does. Prior to this, multifamily was anchoring or weighing down single family rents that otherwise would have happened. So that glut of multifamily has come. It is being absorbed. And then so as I start to look to 2026, I don't see that same glut of multifamily being out there. We know that single family is undersupplied for rental housing, and that puts us as rental property investors, single family rental property investors, in a position of strength for increased rents, especially against the backdrop of population growth and median income growth, which we see here in Jacksonville.
Good stuff. So strong rent appreciation coming up in Jacksonville in the near future is what we think.
I think so. Looking into 2026 is that's where we're keeping our eyes as far as some significant rent growth gains.
There you go, Raj. Okay, so now we get to go back to home sales activities. NAR is projecting existing home sales to increase by 11% in 2026 after a 6% rise in 2025. New home sales, they're saying, expected to rise by 5% in 2026. Bankrate and other analysts are seeing a 10 to 15% increase in existing home sales as affordability improves and more inventory comes to market. And the market is just kind of expected to become a little bit more balanced, less intense competition than the recent years. GC, what do you think about the prospects of home sales? Do you think home sales will be going up or down as we round out this year?
Well, it's really important to talk about which type of home sales are we talking about. There's existing home sales, and then there's new construction home sales, and two very different stories. So I think the percentages that they put in that article for existing home sales make a lot of sense to me. I would see that existing home sales would jump up double-digit growth as far as existing home sales makes a lot of sense. Part of that, and the big reason though, is because we're starting from very low levels of existing inventory. When COVID happened and low interest rates happened, there was almost zero existing inventory in markets across the country and definitely in Jacksonville. And what happened is builders, single family and multifamily, but maybe we'll talk mainly about single family now, swooped in and built as much as they possibly could, but it was hard to build because of all of the supply chain challenges. And so builders have been trying to build as much as they can on single family. And so as they built new construction homes, the only reason we were able to have any inventory over the last, call it 5 years, is because it was largely new construction. So you're starting with a very low level of existing home sales over the years, and you're starting with a high number for new construction home sales. And so the existing sales, I would expect to go up. That makes sense because of the low level that we're starting at. And it also makes sense because existing inventory generally is lower priced than new construction. And, you know, against the home price affordability challenges that we are all facing in this country, it makes sense that if you have a more affordable product and you now have more of it because there's more inventory today than there was a year ago, that you should see pretty large jumps and gains into for existing home sales.
Okay, so we see existing home sales jumping. You're saying it's going to speed up, right? It's gonna start getting better.
Yeah, you know, we've been on a trend of increased inventory for a number of years. We predicted it. It's healthy for the market. And the biggest gains are on a percentage basis are coming from existing inventory. And part of this also is because you have less of that lock-in effect of interest rates. We've kind of talked about this in the past where, you know, after interest rates were 3 and 4%, nobody was selling their house to move. But now what's happened is you got a couple of things that are going on. Interest rates are lower than what they were, you know, a year ago. So that's good. People are getting antsy, and some of them are going to say, well, I'm going to move no matter what, because I've been waiting 3 years to move. You know, I don't care if my interest rate is so low before, I'll deal with it.
Yep.
And then people have a ton of equity too. So people have a lot of equity that's trapped in their homes is how they feel. And if they sell their home, then they can unlock that equity. So all those things are moving to a place where the lock-in effect, which means that people would not sell their home before simply because of the interest rate, is becoming less impactful. And Yeah, so that's going to increase inventory as well.
Got it. Got it. So speaking of inventory, right? Like the final thing is essentially the housing supply, right? NAHB is forecasting 1.05 new single family house starts in 2026. US still estimated to be 4.5 million homes short of demand. So inventory constraints will persist in many areas, and multifamily construction is expected to slow, which may put an upward pressure on rents. You kind of touched on a lot of that stuff in the last two segments, but essentially, um, I think the big picture is there is going to be more construction activity happening in the single family space, but it's not even making a dent into like the supply demand numbers. Is kind of what I'm seeing.
As an investor, you want to be buying and holding something that there is not enough of. Just as simple as that. And housing fits that description. Single family housing has been undersupplied ever since the Great Recession. And it takes a long time for single family housing to recover. What's interesting is that there's so many ways to win in this puzzle of how to react in a high interest rate environment. There's so many ways to win as a single family rental property investor. Here's one example. We have higher interest rates than we all want. As a builder, Pablo, do you want higher interest rates if you're going to go out and build a whole bunch of inventory, or do you want lower interest rates?
I would prefer lower interest
You would
rates.
want lower interest rates. So what are these high interest rates doing to production of single family homes?
They're making me a little bit more careful about how many I start.
There you go. There you go.
Yeah,
And the profit margins are decreasing for builders as well.
of course.
So ultimately, we need builders to build as much as we can to get us out of this affordability crisis by building more homes. That's the way to do it. But higher interest rates actually inhibit that. And that's just the way it is. What can you do about this as an investor? You can buy and hold these beautiful single family rental properties, right? You're in a position of strength. Really, no matter what is thrown at us, and we have seen this for as long as we've been doing this show, and that's been 5 years, and for the last 20 years that I've been investing in these beautiful single family rental properties, we have seen everything thrown at this asset class, but it continues to win. And the reason is because at the end of the day, it is a critical need for the investor, and it's a critical need for the government for single family homes to be affordable and for them to and for that to work. Our economy, a lot of it is based on housing.
Yeah.
So you want to hold something that is that important to the individual, and you want to hold something that is that important to the government, especially if it is in low supply. And that's what we get to do as single family rental property investors.
Investing in something that is undersupplied for the existing inelastic demand in an essential need seems like the formula for a high floor investment,
Exactly.
right?
Exactly.
Um, Ernest Gargas has a good question. Ernest, I hope you keep coming, man. You got some great stuff here. Says, question, don't we need a good balance between multifamily and single family? Do you see any pattern on what is now happening and what happened like the 50s and 70s, or perhaps even earlier?
I wasn't around in the 50s to 70s, so need a little bit more insight, specifically what we're talking about there. But what I can share with you is that you generally have a good balance of multifamily and single family builds. Generally, multifamily rent increases about 3% per year. Single family increases about 3.6% per year. I'm referencing Jacksonville information, and that's pretty normal for the rest of the country. So increases tend to come along with the rate of inflation. And so it's a stable asset class. What we're seeing over the last few years are, let's face it, wild swings in interest rates and in supply chains and other things and in migrations as well. A ton of people moving to places like Jacksonville and states like Florida and Texas. So you're just seeing a lot of huge pendulum swings in a short period of time. And that's why you start to actually see some potential changes to the consistency of rents, right? Very, very unique for multifamily rents to go negative. And that's what we have seen for multifamily rents the last 2 years. So this is, to your question, do we need this? Do we need to do something different in order for kind of like a balance or a normalcy to come to multifamily and single family. We just need the world to calm down a little bit and go back to the way it
That's
was
it.
prior to COVID.
Yeah.
I think we're all kind of waiting for that. We continue to see the after effects of an easy money policy time frame and then huge net migration changes along with the advent of new technologies that are changing the world. So I do think that we will get back to less huge pendulum swings in a short period of time. This has been a historic time to be a human and as an investor, and I do expect that will sort of meter out. But specifically, single family rental properties have been the darling of consistency even through that. So I just think it will keep doing what it's doing. Multifamily will go back to being relatively consistent, assuming we don't have interest rates that go way down and then interest rates that go way up.
Got it. Let's put a bow on this, GC. Prediction for second half of 2025. Is it a good time to be buying rental properties in Jacksonville?
Once you take the time to understand how you win in a high interest rate environment, single family rental properties are about the best asset class that you can invest in. If you are looking for risk adjusted returns, if you're looking for a high floor and you're looking for significant upside, actually doing the opposite of what conventional wisdom or what you read in the headlines, doing the opposite of that is what you should be doing right now. You should be buying single family rental properties while interest rates are high, while home sales are low, because we look at what happens on the other side of high interest rates. And I don't know if the interest rates are going to go lower today, a year from now, 2 years from now, but at some point they will. And all that's happening in regards to home sales and home price appreciation is this coil effect. What's the sound? What's the sound, Pablo?
Well, not when it's coiling, but when it springs, the sound is.
There we go. That's what's going to happen with home sales. That's what's going to happen with home price appreciation. So if you are a buy and hold investor, actually buying, educating yourself on buying while interest rates are high is a huge opportunity for you. What it's going to result in is you having higher home price appreciation in your portfolio, higher cash flows in your portfolio, and you're going to wind up in the same place with low interest rates that you can just refinance into when they eventually do come down.
And if you want some background reading on the coil effect and how all this stuff works, the best place to get that is our quarterly market update. It was a lot of what we talked about in this publication here. Go to jwbrealestatecapital.com/report. Joanna just put it in the chat, so you can just click on that thing. This was a great show, GC. Good stuff, man. You brought it. I appreciate you showing up with the research and the perspective. I think it's really, really awesome. I love the fact that it's like the week of 4th of July. We still get 60 plus people that spend a day, an hour in the middle of their workday coming over here. New folks like Ernest that are contributing to the community on day one already, and just making a habit out of it. We never take that for granted. That's why we prepare so much. That's why we make a real point of bringing not obvious, not average perspectives in here of the things that people really, really need to hear based on 20 plus years of investment and real market expertise. So really appreciate the community making this one awesome. And GC, this is just a tradition for us at this point, right?
I love it.
Yeah,
I really do. Thank you guys for giving me the opportunity to to share a little bit of our thoughts here. It's always really nice to kind of gauge those against other publications out there. And, the thing about our show, and as you continue to be more and more a part of this community, is we always keep receipts for what we have predicted here.
Yeah.
And, we've tended to do quite well, which has really helped a lot of our investors. But if you want to see what actually happens and transpires from the report that we put together quarterly over and over, and then of course annually as we predict what's going to happen for our clients here, keep tuning in, because your built-in accountability makes us great.
If you want to see receipts, tune in quarterly. If you want to make friends, tune in weekly, because that's what we got going on out here in the Not Your Average Investor community. Next week, we've noticed in our community that we have many folks that are investors here that aren't first-time investors. In fact, they're a specific type of not first-time investor. They're the type of investor that had a bad experience in their first one and had to muster up a whole bunch of courage to get back into the real estate train and believe in it. So we're doing a show about when rental properties go wrong. We're going to break down some of these things that have happened to the folks that started elsewhere and then came to JWB, and what, like what they needed to happen in order to like really get back into the game. So if you've ever been burned before, or if you don't want to be burned, you're going to want to be at this show next week. GC, from now till then, any little bit of advice for the community?
Don't be average.
Don't
See
be
you,
average.
everybody.
Happy 4th of July.